Hello, everyone, and welcome to another episode of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw. I am a licensed real estate broker and realtor right here in Silicon Valley, California. Welcome to this week's show. We're going to do a little bit of something interesting, or at least I think interesting. I hope it's interesting. A little different from usual. Now, last week we did something very different. I didn't mention this till the very end of the show, so only those of you who stayed beyond the buy got the notice on this one. But last week's show was generated entirely by artificial intelligence with very little tweaking by me. There were a few things I tweaked in there, but nothing of real significance. So, and for those of you who are regular listeners to the show, you could probably tell the way I was speaking was a little bit less natural. For those of you who watched the video, you could clearly see I was looking at something the entire time. So it wasn't like I was trying to be super sly about it, but I wanted to demonstrate a point, and that is based on a show I did a few weeks back where I talked about people being able to present a certain level of knowledge and professionalism in a very managed environment to get you to interact with them. Right? And I'm talking obviously specifically about real estate. So as I mentioned, all of the main points in last week's show were generated by ChatGPT, the super hot AI that everyone seems to be talking about in the headlines and everywhere else. And every YouTube video tells you how to leverage it in your business. Or there have been headlines about lawyers using it to write briefs on things where ChatGPT made up cases that didn't exist. There's a lot of interesting things going on about ChatGPT. But the point was, you as someone trying to make the decision of how do you pick your real estate professional or any professional in your life, what's the smart way to do it? And so much of it is now becoming a cautionary tale based on you having to go back to old school techniques to really evaluate whether or not someone is appropriate to work with when you're making some of the biggest decisions in your life, whether that's something relating to your lawyer or your real estate agent or your real estate broker, whatever. How do you actually know what's going on? The email you're getting, the assessment of your property, the chat interaction, these could all be generated by ChatGPT, specifically designed to communicate to you a sense of authority based on the person you're interacting with that doesn't exist in the real world. And that's a bad thing. Because the reality is the ability of that person to actually know the subjects that they're talking about is critically important to your success. So first, did you notice last week that maybe you noticed something was different? Maybe you thought, aside from the fact the show was also very short, right? When I kind of riff and just sort of let all of the brain juice come out of my head, it tends to go a lot longer than 6-9 minutes, whatever last week's show was. But did you notice? And did you see a difference in tone? Did you feel like the value of the information was as high as what I like to think we usually provide here on Real Estate Realities? What were the differences? Obviously, the tone I thought was different. I think it was pretty clear that it was being read. I didn't have a teleprompter, so you could see that I was looking at something else. I think that with a little practice, I could address these things and become good at hiding it. But it doesn't make me any better at the actual business of real estate, which is the point, right? For you to make a good decision. Would you have assumed after listening to that, or the content of it, would you have assumed a higher level of knowledge and topic authority from someone speaking about the topic in that kind of a venue, in a podcast like that? Now, what this brings home, and it's something I always try to leave you with, is the value proposition, right? What should you take away from our interactions on the podcast to protect you in your day-to-day life? Well, I think that as it relates to that, the constant need to be critical and focus on real-time, face-to-face, or at least phone interactions with those who you are evaluating on whether or not you're going to work with them is more critical now than ever. Now, can I talk to you intelligently about the difference between single-family residential and condominium homes in a one-to-one face-to-face environment? Absolutely. But I think as you move through the world, when you start to notice a disconnect between easily staged or managed interactions you have with someone you're trying to work with versus how they present in person, I think you need to, because this is going to become more and more common. Trust me, anything that leans into manipulating perception is going to get embraced by everybody. And at the very least, real estate agents are going to be at the very forefront of that particular line. I know I usually save the taking sips of coffee for the coffee and real estate live chat, which is coming up here in August. So make sure to join me. That's on the third Saturday. I would love to see you there where we can talk about real estate. And that's live, so there's not going to be any ChatGPT shenanigans going on during that time either. But I kind of wanted to hit that because I think this is a skill you need to take forward with you, not just in the world of real estate, but in the world of everything. It used to be A-okay to start and sort of push through a relationship with just using emails and texts. I no longer think that is a reasonable way to approach establishing professional relationships with people you're going to be working with. So, having discussed that just a bit, let me jump into what I really wanted to talk about today is subprime lending. Now, for those of you who've been listening to the show for a long time, you know that subprime lending has been a topic that has come up a lot. It is one of the critical factors that contributed to the downturn in 2007 and 8. It's one of those things where I've talked about the two sides of the same coin, right? Where we like to think that we've solved the subprime lending problem by addressing the things that were the primary pushers of it the first time around. But then what we did is flip to that coin and tweak things on the other side to recreate the exact same problem. And to sort of run that down real quickly, the first time around, people were not qualified to borrow. And we simply said, okay, that's no problem. We'll do it anyway, right? No money down loans, no doc fees, no documentation required at all, no income or low income loans, 110% loans. It was insane. So then we decided, well, wow, we really need to pay attention to credit ratings. We really need to do all these other things that we kind of were ignoring the first time around. So then what's the first thing we started doing about 3 years after starting to do that? We started to diminish the relevance of credit ratings. Things that used to negatively affect your credit rating no longer affect your credit rating, even though they should. Medical delinquencies, all kinds of not paying your phone bill, etc. These are all things that suddenly did not count towards your credit rating. And the bottom line is it's a capacity to pay measurement, right? So no one's going to cancel their phone because they cancel because it's not an element of credit, right? It's simply ability to pay on that point. And most people aren't going to cancel their phone service because they need it to communicate, right? And if they stop paying, the service stops. That's not what happens with your mortgage. When you stop paying for some period of time, you still stay in your house. So and the medical thing was crazy in terms of simply not, in terms of just ignoring it. But there's a show I did 2017, 2016, where everybody was bragging about there being this 30% jump in credit ratings. And no one wanted to talk about why there was a 30% jump in credit ratings. It had nothing to do with suddenly more financial discipline on the part of some 30% of people out there with credit ratings. It had entirely to do with how credit ratings were measured. So instead of ignoring the thing we used to measure credit, we tweaked it so that we could force the process of potentially doing subprime lending to people who on paper for their number looked good, but weren't really good. Now, and then to sort of wrap all this up, why would banks want to do subprime lending in the first place? Well, first, because the government encourages them to. In fact, because of the Community Reinvestment Act from the early 70s, banks are forced to do this because if they don't, the government will not let them build more branches. They won't let them expand. They have and they started doing this in the 90s, and lo and behold, we started to see things go crazy with lending in the late 90s. So it's a form of extortion where, the government will say, you're not lending enough to this disadvantaged community, so we're not going to let you open that new branch in downtown LA or Atlanta or Charlotte or wherever they want to do it. And this was an actual case. You can go and look this up. This was in 94, 93, right in that ballpark. Because the Community Reinvestment Act really never had teeth, but then they had teeth that weren't used, and then suddenly started using it in the 90s. So how do banks manage that? Well, It's the secondary market. You underwrite a subprime loan and you make sure to check all the check boxes on an FHA loan, on a Fannie and Freddie loan. And remember, let's not pretend that these elements were created out here in the world where us rational people live. This was created in the world of government. And so what ended up happening is these banks would underwrite these loans specifically with the goal of then selling it on the secondary market to like Fannie and Freddie and FHA, right? Because they could underwrite them without ever owning the risk. So it was zero risk to them, and the risk ended up being taken by who? By you, because your tax dollars support Fannie and Freddie and FHA and all those other wonderful things to cause trouble. Now, and we could talk about how that's bad for taxpayers, how it's bad for the government, how it's bad for real estate markets because it creates artificial demand that shouldn't exist. But here's the thing. The whole premise that you are helping people with subprime lending is a lie, because it hurts people who are borrowing in a subprime way because they're still subprime borrowers. You're not solving the problem. You're simply ignoring the problem and saying, well, we realize that these folks, for whatever reason, are subprime borrowers, but instead of addressing the actual issue that makes them subprime borrowers, we're simply going to skirt rules and lend to them anyway, because they not only are they subprime, but they also happen to fit into some class of folks that for political reasons we want to prefer in lending practices. So let's talk about that a little bit. In the world of rational people who simply want to have an honest talk about subprime lending, I think there's basically two camps. One, which is the one that wins, which is the one that is politically expedient and is like giving away stuff. So the government is usually very much into the giving away of things, is to subvert normal lending policies and rules to allow lending to groups based on some kind of perceived disadvantages. The disadvantage perception being they can't buy because they're not qualified. The real disadvantage is they don't know how to be non-subprime borrowers. They don't have the skill set. And it's simply a question of education, because it's not beyond their capacity. It's that the things that make a good borrower or a lower risk borrower lower risk is habits. It's not some sort of genetically built-in characteristic. It's just learning things, how to manage your money, how to balance your checkbook, what return on investment can you get from an index fund versus contributing to your 401k if you have one at work, right? I mean, these are all things that people need to know to be financially secure in the world we live in, that nobody teaches them. Nobody in high school is learning this stuff. I'm not even sure there's college classes that are teaching these things. The next one is to provide the tools and knowledge to allow home buyers to escape the classification of subprime. And that is the camp I firmly fall in. I think it is. I do not want to make people reliant on the quote unquote generosity of some government idiot in Washington, D.C. or up in Sacramento, California, if you happen to share my state of residence, for them to give stuff to people, right? A lot of us have accumulated knowledge relating to financial needs and what we do and don't do with our money. And we act responsibly. We understand how to live within our budget. We understand how to budget. And what you find is that there is far less victimization in this and far more lack of knowledge. That is an absolutely solvable problem. And it's not like it takes decades. This is a deal where if you train someone who is currently a subprime borrower on how to not be subprime, it's not going to take months. It's not going to take years. It's going to take weeks to teach them the skills. Now, of course, there's going to have to be follow-up. It's going to have to be one of those things where they learn the habits, and good habits take about 3 months, from my understanding, to kick in. Some of us, it takes a little longer. We're a little thicker, and it may take longer. But understanding how to do these things and understanding the finances, the balancing of the checkbook, how different bank accounts work, how saving works and how different saving vehicles can reap greater rewards, and understanding the value proposition of maybe, because here's the thing that's happening right now that's nuts. For those of you who've been checking out the headlines and follow the car industry at all, and the only reason I follow that is because I'm interested in debt profiles for people in general. And we're seeing a huge uptick in the number of repossessions of cars, new cars, because people can't afford the payments anymore. We have been through this period of time where people were willingly buying cars way beyond their ability to pay for them, where monthly payments were more than $1,000 on average, which is just nuts. And so if folks had the ability to analyze these situations, realize how much that interest is really costing them, how much this extension of the loan from being 2 years to 3 years to 4 years to 5 years is in the long run a bad thing. Understanding long-term impacts on their cash flow of making these various commitments, a deeper understanding of that is going to create a class of folks who do not have to rely on people breaking the rules for them to get a house, but rather people who need nobody. They don't need me. They don't need a senator. They don't need a congressman. They don't need FHA. They don't need Fannie Mae. They don't need Freddie Mac. They know how the system works, and they're able to work it for themselves, because the bottom line is no one cares more about your success than you do. I do not care how many people tell you that your benefit is their top concern. And even though I consider myself someone that puts my clients' needs absolutely at the top, even in that case, and assuming I am being completely honest about that, my guess is that you still have a greater investment in your success than I do, because that's just naturally how things work, right? And I see it slightly differently. I see a giant community benefit from the strongest individual members of that community as possible. So if you're a member of the real estate community, which means you've bought a house, you rent a house, so basically everyone that you know is part of the real estate community, your higher level of knowledge and ability to manage your finances simply makes you a stronger individual contributor to that community, and that benefits me. So even if you want to look at it from a selfish standpoint, that is the way to do it. So, and here's what's really annoying is if you go up onto Google and you do a search on why are subprime loans bad, you're not going to get a discussion of what I'm about to cover, which is they are so damaging to the borrowers. I mean, in the last downturn, all those folks who took subprime loans lost their houses, just straight up. And it was one of the most financially painful things to watch unfold for people as I tried to help them get out from under this debt that they simply were not equipped to manage in any way. Now, in some cases, I was able to get people to buy into the idea of educating themselves and restructuring their debt and they may still have had a job, so things were looking good for them. And they may have been able to keep their home because they started learning the lessons of being a smart borrower a little later than one would hope, but started learning them enough so that they could manage their personal finances and move forward. But the vast majority got hosed by this stuff. So one of the primary reasons why I'm so against this is the only people who win in subprime lending, who really win, are the banks. And that's it. Because eventually you get a downturn. Now, who knows what's going to happen over the next year? There are an awful lot of people on both sides of the spectrum that say, hey, we're done. The market's going to be fine. I still see an awful lot of weakness in the market that could lead us to a downturn. So in a questionable market moving forward, making a subprime loan seems like one of the dumbest things you could possibly do, just because that level of uncertainty is there. And you could potentially be doing things a lot better for yourself by having that knowledge. So, but you're not going to get any of that kind of discussion from any of these folks like Forbes, or we're going to talk, Experian is one of the two articles I'm going to show you. But they're going to talk about the technical end of it and why it's bad. And these are good reasons why it's bad, and are absolutely reasons why we should stop doing them and focus on education. But they don't talk about how the person who gets screwed when things go off the tracks are the borrowers. It's not the banks. It's the taxpayers vis-a-vis Fannie and Freddie and FHA. So let's go ahead and look at these real quick and see what the acceptable media world defines as what a subprime mortgage is and its benefits and risks, right? So they describe a subprime mortgage as a loan that allows someone with a limited credit history or subprime credit to purchase or refinance a home. The Consumer Financial Protection Bureau identifies subprime as credit scores between 580 and 619. In comparison, you'll need a score of at least 620 to qualify for a conventional mortgage, but you'll need a far higher score, often at least 760, to get the lender's best pricing. And this is a number. This is not where you grew up, who your parents are. This is strictly how have you managed your financial world up to this point in terms of reliability. If you borrow $30 from me, how likely is it you'll pay me back on the promised date. That's what this number is supposed to be indicating. Types of subprime mortgages, fixed rate mortgages. These are nuts. With fixed rate mortgages can last 40 to 50 years because they make the term longer. That is horrible for you. A longer term on a fixed rate mortgage is insane because in addition to that, you're going to be paying a higher interest rate for that fixed rate mortgage. Adjustable rate mortgages, which are also at least dumb right now. I mean, it's all context, right? You're not saving enough on adjustable rate mortgages. But these are the worst, particularly for the financially challenged, because these ones represent numbers that will change after some period of time. If the rate can adjust after 5 years, that's after that 5 years is up, the interest rate is going to move depending on where the interest rates overall are at that point. And then you're hosed. If suddenly if you're someone who is not financially savvy with your own finances, if you're someone who's not educated in the world of balancing budgets and staying on track with your finances, how much does $100 a month matter to you? Probably quite a bit, particularly if you also just bought a brand new car with no money down, where you're going to pay $1,000 a month, which is also a very common for folks in the subprime lending world. That no money down, $1,000 plus a month payment is far more common than you would imagine. Interest-only mortgages, also horrible. When making payments on an interest-only loan, the funds go toward only the accumulated interest for the first 7 to 10 years. Then payments will go toward paying down principal and interest for the rest of the term. Next, dignity mortgages. These types of mortgages is like a hybrid of a subprime and conventional mortgages. Borrowers put down about 10% and agree to pay higher interest rates for the first few years, typically 5. If they make all their payments on time, the rate is lowered to the prime rate, the interest rate banks charge their most creditworthy customers. I have less of a problem with this one if over some period of time they have proven themselves to be as good of a credit risk as someone with a much higher credit rating. Great. I don't think I have a problem with this one. It's got a little skin in the game. Skin in the game should be a requirement at all levels. You shouldn't be able to get no money down loans as a consumer buying a house, simply because in a highly fluctuating marketplace, that could simply make a lot of sense for you to stop making the payments on your house and just ride the wave. But this one is of the options here, probably the most reasonable and the one I probably have the least problem with. But why not make none of these necessary? Why not make it so that someone has been personally educated enough and changed the way they manage their finances that none of these are even necessary for them? They don't need your help because they've got the knowledge necessary to proceed in this financial endeavor without anybody having to make any special changes for them. So the goal, at least the first level goal, right? I mean, we can have a conversation about what kinds of subprime lending might exist, but let's at least satisfy we have educated consumers as much as possible. Instead of making the first step of the subprime borrowing process why don't we make the first step? You have to go through a mandatory class on personal finance, financial management of your own stuff, investment vehicles, all these kinds of things. And it doesn't need to be years. This isn't a subject that requires years and years of study. It could even be an online thing. But why not make that the first step? Why not make the accumulation of knowledge and personal power in your own finances the first step? All right. Who are subprime mortgage borrowers? They throw some things down here, but the list is wider. And also remember that we have jury-rigged the system this time around to artificially bloat credit ratings versus what if I were to tell you what my son's credit rating is, my son has no credit history, none. If I were a lender and I was making a loan, now I happen to know that my son would likely be a good credit risk because hopefully he's learned the lessons I've taught him as he grew up. But he's got no credit history at all. He doesn't have a car loan. He doesn't have a credit card in his own name. How does he have a credit rating of what I believe was 760 when he was stunned to discover this a few weeks ago? The complete absence of a credit history equals 760, apparently, in the modern world. All right. Is a subprime mortgage right for me? Benefits and risks. Now, notice that none of these talk about the aftermath of downturns because they don't want to cover that kind of risk, right? This is the good folks at Forbes. Higher rates. Yes, and they should have higher rates, but even in some cases, we see that there are government programs that are designed to minimize these things. Larger down payment. Again, another way to some lenders offset the risk of subprime mortgages is by requiring higher down payments. Also not universally true. For those of us in the real estate business, we know we have worked through the process with enough subprime borrowers to realize the way that subprime mortgages get managed in terms of risk is the banks don't accept the risk. They sell the loan on the secondary market. As long as they underwrite it and check all the check boxes required by the federal government, they can sell it on the secondary market where the federal government and their agencies, the government-sponsored entities, the GSEs, if you ever see that in a news article, that's what they're talking about. They're talking about Fannie, Freddie, FHA. The bottom line is they take the risk. That's why there was a big stir right after the downturn last time where the government wanted to come after banks for not adequately checking all the check boxes so that they could go back to the bank to try to recover some stuff. Notice that the news relating to that kind of died down quickly because the complicity of the government in this kind of becomes very clear once you start looking too closely at it. So a larger down payment is, while I think in a sane world that makes more sense, is not something I saw a whole lot of. In fact, we've done shows on this podcast where we talked about loans that required 1% down or 0% down because some locality would pony up the rest of the 3% or 2%. In subprime borrowing, I rarely saw anyone coming up with 10%. It was typically less than 5%. So I'm not sure. I guess this is on paper something that happens, but it sure wasn't in the market I'm seeing, and it hasn't been in the market I've been looking at for the last, well, geez, how long have I been in this specific market? 20 plus years. I've been doing this over 35 years, and just not the way I'm. Of course, subprime lending didn't become more of a thing until after 2000. But anyway, higher payments. Well, yes, that's a natural relationship between higher rates and higher payments. Just makes sense, and longer terms, which is also a bad thing. We already discussed that. And then, of course, it's how to find the best subprime mortgage lenders, right? Because you have to generate the business. The reality is that banks make money lending money. So as long as there's money flowing, they're making money. So in the end, what you've got is a borrower who now is saddled with more debt than they are intellectually capable of managing, not because they don't have the intellectual capacity, simply because they've never learned. They've never been taught these basic lessons of personal finance. You've got someone who isn't equipped to manage this debt rationally, and you've got a bank that's making a pile of money off of it, and a bank that's not going to assume the risk for that borrower, but rather sell this loan on the secondary market back to the government so that the risk is ended up on your shoulders. And that's how we get things like TARP last time. Remember that one? The $200 billion bailout that was one of many bailouts during that time frame. I think the one that finally was one step too far for me was that final $200 billion, George Bush thing that was celebrated as a good thing, which I personally don't think was. But anyway, so, I wanted to share that with you. And then there's and these are the two top results. If you do a search on why subprime lending is bad for borrowers, these are the top two results you're going to get. And they basically come in with the same information: high closing costs, high interest rates, adjustable rate mortgages, extended term mortgages, interest only mortgages. But again, none of these talk about how negative it can be if something turns down in the market for you as the borrower. The burden is usually unmanageable and results in you usually losing your house. And the number of folks who lost their houses last time was insane. So I wanted to throw this out there. I'd love to get your thoughts on it. I think there are ways that benefit borrowers far more. Teach people how not to be subprime. Don't circumvent the rules so that they can continue to exist in oppressive subprime lending scenarios that really spell doom for them if anything negative happens in their financial profile, right? Even if the market doesn't take a nasty turn, if their profession takes a nasty turn, if something else in their life goes nuts, and they have absolutely no ability to understand how to manage their debt and how to save and how to have money set aside for important life events or anything else like that. They are just waiting for this financial bomb to explode in their laps, which could end up with them losing their homes. All right, folks. That just about covers it. I hope this has been beneficial to everyone. The goal is always to leave more knowledge on the table than I take up in your time. I would love to hear from you. Feel free to comment at my website, soldbyrobert.com. You can find this show there. You can also go to YouTube to watch the video version of this, and you can comment against the video if you would like. And if you do visit me there, please do like and subscribe. That helps with the algorithm and gets everything rocking and rolling and gets the message out to far more people. And then my goal is always to reach far more people. In any event, thanks for listening, and I will talk to you all next time.